So if you're watching this video, it means that either 1, you just started investing in the stock market, or 2, you're actually looking to start investing in the stock market. Hi guys, my name is Devroy Davis and this is Beyond the Stock Price. So in this video, I'm basically going to be going over 3 things that beginner stock market investors need to know. So the first thing you need to know is if you're actually buying stocks, then you are buying an ownership interest in an actual business. If you buy stock, then you are called a shareholder, which means you own shares in the actual company. It's not uncommon for a lot of persons to actually just buy stocks because of the name of the company, or because there is a new IPO, or because literally somebody told them that this stock is going to be going up in the short term. That is whether it's next week or next month. However, this is not necessarily a very prudent way to go about investing in the stock market. I think that there are at least 3 things that you want to know about a company before you purchase the stock. Number 1, you want to know what business the company is actually in. So that means you want to know what product or service the company offers and how the company makes money. The next thing is that you want to also have an understanding of what that business is. So if you're buying shares in, say, a bank, then you at least want to have a fair understanding of how the bank is actually making its money. Now, many banks make their money by offering loans from the deposits that they actually get from other people. These loans are normally offered to individuals or businesses to either meet their immediate needs or for the purposes of expansion. So it's very important that as an investor in a business, you have an understanding of what that business is actually doing and how it is actually making money. The second thing you want to know is, as an investor, we want to have an understanding of who the management team is, what their experiences are, and if they actually have the capabilities to lead this company, say, into the future. That is, to make the company more profitable 2, 3, 5 years down the line. And then lastly, we want to have an understanding of the company's ability to make money. So you want to know whether the company has been profitable, whether it currently is profitable, and what the management is doing or plans to do in order to make the company more valuable into the future. So that leads me into the second point, which is stocks are normally for the long run. So when we're buying stocks, we're not buying them with the expectation that they're going to go up 10 or even 20% next week or next month. We're hoping that what will happen is that the market will actually see the company as more valuable over time as the company generates more and more income. Taken over the long term, the stock market has actually outperformed all other asset classes. It has done better than real estate, it's done better than bonds, it's done better than commodities such as oil or gold. It has certainly done better than saving cash. The thing though is that it takes time for us to actually see the benefits of investing in the stock of really good companies. It can take anywhere from 5 to 10 years for an actual company to come into its own. That is, for it to reach a point where it is consistently earning better and better revenues and better net income year over year. Think of companies like Apple or Microsoft or even NCB Financial Group. The point I'm making here is that it takes a reasonable amount of time, anywhere from between 5 to even 20 years, for a company to actually build up that reputation of earning consistent earnings year over year. Peter Lynch said that if you cannot own a stock for 10 years, you probably shouldn't own it for 10 minutes. And the point he's making is that when you're buying stocks, you have to adopt the long view of it. If you're not willing to hold on to the stocks for a fairly long time, then you probably shouldn't buy it at all. Now, the third thing you need to know as a beginner in the stock market is that there are two primary ways that you can earn money in the stock market, but there are also two ways that you can actually lose money. It would be plainly unfair of me if I did not tell you that it is possible to lose money in the stock market. The first and most obvious way that you can lose money in the stock market is if you buy a stock and then sell it for a price lower than you had bought it. Now, you might ask me the question, why would somebody sell their stock at a price lower than what they bought it? But there are actually legitimate reasons why a person might want to do this. I'll be doing another video where I'll be going into some of those reasons, so be sure to click that subscribe button so you don't miss that video, and consider clicking on that bell so that you get the notification as soon as that video goes live. The second way that you can actually lose money in the stock market is if you buy stock in a company and then the company ends up filing for bankruptcy. For example, if you buy stock in, say, an early stage company, a company that has just had an IPO, for instance, and the company has difficulty in then generating positive earnings over the next 2 or 3 years, the company might end up having to file for bankruptcy, and the company might end up filing for bankruptcy and will be liquidated. Now, what that means is that the company will end up having to sell off all of its assets, which could be its buildings, properties, or machines, and then it will have to repay its debts. Now, when the company is liquidated, the first persons that are paid are the company's debtors. Next would be the preference shareholders. I recently wrote an article about the difference between preference shareholders and ordinary shareholders on the Caribbean Value Investor website. The link to that is actually in the description below, and there is also a quiz that will actually allow you to test your knowledge on what the article speaks about. When the company is liquidated, the debtors are paid first, then the preference shareholders, and then the ordinary shareholders. Typically, an investor is able to basically see the writings on the wall for a company that is headed to bankruptcy. And he's able to do this by analyzing both the quarterly and the annual financial statements. Also, in the annual report, the company has a responsibility to actually tell you about whether or not there is what is known as a going concern. That is a reason for investors to be worried about the future of the company. Now, if that happens and the company is actually liquidated and the debtors are paid, then preference shareholders are paid, and there is no money left over for the ordinary shareholders, then you'd have effectively lost your investment. It's not only small companies that run the risk of actually filing for bankruptcy though, because there are actually many large companies in the past that have actually gone out of business due to competition or just the advancement in technologies. Examples are AIG, Enron, and Toys R Us. Alright, so that's enough bad news. On to how you actually make money in the stock market. So, as I mentioned before, there are two primary ways that you can make money in the stock market. The first way is through dividends. So normally, as a company grows, the earnings of the company grows, and management may actually make the decision to pay out some of the earnings as a dividend to the shareholders. Remember, when you buy the stock, you become a part owner in the company. As a shareholder, you are entitled to a share of the profits of the company or a claim on the assets of the company. So when management actually decides to pay out a dividend, you as a shareholder will actually get a check in proportion to the amount of stock that you own in the company. The second way is through what is known as capital appreciation. If, for example, you buy a stock at, say, $10 per share, and over the next 2 or 3 years the stock goes up to $12 per share, then you would have gotten what is known as capital appreciation on your invested capital. what that basically just means is that the value of the company has gone up and you can now sell your shares at a profit. If your stock goes from $10 to $12, then you would have actually gotten an unrealized gain of 20%. It is known as an unrealized gain because it is a gain on paper. And now, in order for you to convert your unrealized gains into real gains, you actually have to sell the stock at the higher price. There will be some fees that will come out of it, but those fees are like typically within the range of like 2 to 5% in total. And so you'd have gotten a net positive gain of between 15 to 18% on the money that you had invested. Okay, so just to recap, if you're a beginner in the stock market, then you want to first have an understanding of the fact that when you buy stocks, you're actually buying a ownership interest in the business. The second thing that you need to remember is that stocks are typically for the long run. So don't go in expecting that you're going to double or triple your money next week or next month. And then the third thing to remember is that you can both gain or lose money in the stock market, and there are two ways that either of these things can occur. Either you could end up in a situation where you're forced to sell your stocks at a lower value than you bought them at, or you might have ended up investing in a company that ends up going out of business. In terms of gains, you gain from investing in the stock market either through capital appreciation or through dividends. Okay guys, so that basically wraps up this video. If you learned something new from this video, please consider clicking that like button and subscribing to Beyond the Stock Price, and more educational videos as well as fundamental analysis on publicly listed companies. And also, please consider sharing this video with anybody you think might be interested in the content that we're sharing here. Alright, so again, thanks for watching and be seeing you next time. Okay guys, so that basically wraps up this video. Thank you for watching, and if you enjoyed this video or if you learned anything, please consider clicking that thumbs up button below and sharing the video with a friend or somebody else you think might just be interested in the content.